In late February 2026, coordinated U.S. and Israeli strikes hit Iranian targets, prompting immediate retaliatory missile and drone attacks. Unlike the contained skirmishes we saw in 2025, this confrontation carries a very real probability of becoming a prolonged structural military conflict. When missiles fly, the immediate assumption among professional portfolio managers is highly predictable. The instinct is to assume that military escalation guarantees sustained risk aversion, capital flight, and deep structural corrections in emerging markets like India. This chart shows the four main transmission channels feared most during a geopolitical shock. Managers brace for heavy foreign portfolio investment outflows, dollar strength weakening the Indian rupee, a massive spike in crude oil, and a broad rotation into risk-off defensive positioning. However, looking at 26 years of hard historical data reveals a clear divergence from this consensus. The math shows that liquidating Indian equities in response to Middle Eastern conflict is statistically incorrect. Instinctually bumping a portfolio at the first sign of a geopolitical crisis relies entirely on an emotional behavioral bias. It ignores the actual empirical mechanics of how the Indian market absorbs and processes external shocks. To test this, we examine a dataset of 12 major geopolitical conflicts dating back to the year 2000. These are specifically wars that had direct or indirect relevance to the Indian economy, through military involvement, oil shocks, or regional spillovers. The baseline of this analysis includes direct military engagements involving India itself, such as the 1999 Kargil conflict. It also accounts for massive global supply chain disruptions and regional spillovers, factoring in events like the Iraq War and the Russia-Ukraine War. The methodology here relies on strict isolation. We separate the initial intense phase of a conflict, the weeks of active, high-volatility military escalation, and compare it against the war's full duration to measure the actual market drawdowns. Testing current market anxiety against this comprehensive 12-war dataset reveals a consistent, repeatable pattern. The Indian market rapidly absorbs the shock rather than suffering a structural collapse. Let's define the intense phase. This is the immediate, high-volatility window right after a military escalation begins, when uncertainty is at its absolute peak. This chart tracks the Nifty 50, India's benchmark index, during these intense phases. The median maximum drawdown is highly contained, dropping exactly 4.1%. Notice the aggressive recovery. The index takes a median of just 0.1 months, roughly 3 days, to completely reverse that drop. A short-term 5 to 7% correction is not a structural failure. It is an entirely sentiment-driven, front-loaded event based on fear rather than a decay in underlying corporate earnings. While foreign portfolio investment does reliably flow out of the country during this specific window, the data confirms this capital flight is strictly temporary. The intense phase is merely a brief psychological shock. Selling early to escape the volatility simply locks in sentiment-driven losses mere days before the statistical mean reversion occurs. When we zoom out from that brief intense phase and look at the equity market's performance over the total lifespan of these geopolitical conflicts, a completely different reality emerges. This chart plots the full duration performance. Counterintuitively, the Nifty 50 overwhelmingly delivers positive returns over the total span of these wars, capturing a median gain of 10.2%. The initial dip is entirely smoothed out. There are rare statistical exceptions, primarily the market correction we saw in 2011 during the Libya and Syria civil wars. However, that 2011 drawdown was driven by distinct global macro stresses and domestic Indian economic factors, rather than the Middle Eastern conflicts themselves. Beyond the early shock phase, markets systematically stabilize. They tune out the distant geopolitical noise and resume trading based on actual fundamental economic trajectories. Prolonged conflicts do not mathematically equal prolonged bear markets. The structural trajectory of Indian equities remains highly insulated from foreign military theaters over a month horizon. To understand exactly how the shock does reach Indian, we have to isolate the primary physical variable that dictates cross-asset stress, crude oil. Oil serves as the ultimate geopolitical shock variable. It represents raw supply disruption fears, particularly acute during Middle Eastern escalations like the US-Iran conflict. This chart tracks historical crude prices during the intense phase, showing a sharp front-loaded median peak rise of 11 stabilizes and traders realize oil is still flowing. This risk premium collapses rapidly. This brings us to the secondary transmission channel, the effect on the Indian rupee. Historically, currency depreciation is highly limited. The rupee sees a median drawdown of only 1.3% against the dollar, generally tracking the exact same trajectory as the temporary oil spike. Just like the equity index, the currency also mean reverts quickly once global risk aversion settles and oil corrects. The entire cross-asset panic is essentially a derivative of the oil risk premium. Unless physical energy infrastructure is permanently destroyed, the market shock is guaranteed to be transitory. During these initial shocks, a portfolio manager's typical tactical response is to rotate heavily out of growth stocks and into defensive equity sectors, like utilities or consumer staples. The historical data proves this rotation is largely ineffective. Defensive equity sector outperformance during conflicts is not systematic, meaning investors rarely find actual shelter there. Across all 12 conflicts studied, there is only one consistent, persistent defensive hedge that reliably absorbs the shock: physical gold. This chart compares the two assets. Gold acts as a true shock absorber, capturing a median peak gain of 6.4% during the intense phase. Crucially, gold's gains are mathematically less volatile than oil and persist much longer in the portfolio before eventually correcting. Attempting to hide in defensive equities is a flawed behavioral response. The data proves that true safe haven allocation requires rotating strictly into gold to weather the initial volatility spike. Applying this data to the present February 2026 US-Israel escalation against Iran provides a clear roadmap. While conflict trajectories are inherently uncertain, a sustained flare in crude prices or a deep, lingering equity correction remains statistically improbable based on 26 years of hard evidence. The absolute threshold for actual structural market damage is extremely high. The conflict would need to extend well beyond 6 months, with actual, sustained destruction of global physical supply chains. Therefore, the strategic directive for asset managers is straightforward. We operate by 3 rigid rules based on our historical playbook. First, managers must tolerate the short-term 5 to 7% equity corrections. Second, expect temporary foreign portfolio outflows, and do not liquidate your own positions in response. Finally, mandate strict adherence to the firm's established 65-35-20 asset allocation strategy. The professional instinct to panic during geopolitical crises is a measurable financial liability. Leveraging historical data allows investors to exploit sentiment-driven dips rather than becoming victims of them.